You think a higher credit score means an automatic financial approval, but behind the digital interface of the modern banking sector, your flawless three-digit number is being treated as a completely irrelevant consumer metric by hyper-automated neural networks that judge your financial existence in milliseconds. You sit at your desk in the quiet hours of the evening, surrounded by the glowing screens of your business dashboards. You have spent months, perhaps years, executing every single piece of conventional financial advice perfectly. You check your consumer monitoring apps, and there it is, a pristine, gleaming 800 FICO score. Your payment history is a flawless line of green check marks stretching back a decade. Your credit utilization is locked down at an immaculate 1%. You have carefully calculated your moves, checked your balances, and verified your stated income figures. With absolute confidence, you navigate to a Tier 1 institutional credit portal to secure the foundational six-figure business line or high-limit card required to scale your enterprise operations. You take a breath, position your cursor over the Submit button, and click. You expect a standard processing wheel to spin for a few days while a human loan officer reviews your credentials. Instead, before your finger even lifts off the mouse, the screen instantly changes. A cold, stark, automated notification displays a single word: denied. Within 400 milliseconds, an invisible system has processed, audited, evaluated, and rejected your entire financial history. The physical sensation of that immediate rejection email hitting your inbox is one of profound systemic confusion. You did everything right according to the public map, yet the institutional gateway slammed shut instantly. You are left staring at a clean file that the banking system has just classified as an unacceptable exposure threat. The psychological weight of this moment settles into the room like a heavy, suffocating fog. You look at the screen, then at your phone, pulling up the monitoring apps once again just to verify that the numbers haven't shifted. They haven't. The 800 score stares back at you, bright and green, an unassailable badge of financial honor that has suddenly been rendered completely powerless. You begin to retrace your steps, pacing the floor, dissecting every micro-action you took over the last 24 months. Did you pay a bill a day late? No. Did you allow a balance to report too high? No. Did you state your income inaccurately? No. The ledger of your actions is perfect. The numbers are clean. Yet, the cold finality of that automated denial letters your desk with the weight of absolute institutional rejection. It feels like a betrayal of the highest order. You were told that if you followed the rules, if you sacrificed and managed your liabilities with precision, the gates of capital would open. You built the perfect profile according to their public declarations, but when you stepped up to demand the leverage you earned, the machine rejected your existence without even spinning its loading wheels. The confusion morphs into a quiet, burning frustration. You realize you are standing in front of an invisible wall. You are shouting at an automated system that doesn't have ears to hear your explanations. The realization hits you that there is a massive, unmapped gap between what you see on your pristine consumer dashboard and what the institutional risk engines are seeing on their hidden internal ledgers. You are left entirely in the dark, holding a perfect score that has just been exposed as nothing more than a superficial marketing illusion. This sense of profound alienation stems directly from the fact that you have been operating under a system of manufactured compliance. For years, you have been conditioned to believe that the three-digit number issued by retail bureaus is the absolute metric of truth in the financial universe. You watch that number tick upward point by point, celebrating each milestone as if it were a direct reflection of your growing purchasing power and credibility. When it reached the elite tiers, you believed you had unlocked a level of absolute safety. But the automated rejection reveals a terrifying structural truth. The public score is a consumer pacifier. While you were meticulously grooming your profile to maintain that pristine number, you were leaving an unmonitored trail of behavioral metadata that the bank's true underwriting models consider highly toxic. The system allowed you to believe you were winning the game because the game they showed you was a completely harmless sandbox designed for retail consumers. The moment you stepped out of that sandbox and requested elite institutional funding, you walked directly into an automated dragnet. Your perfection was evaluated by a machine learning network that doesn't respect your score, doesn't value your timeline, and doesn't operate on retail rules. You are dealing with an institutional entity that has completely decoupled its risk assessment from the public bureaus, leaving millions of high-performing individuals completely exposed to immediate systemic denials that they cannot comprehend or reverse. This profound systemic betrayal happens because the personal finance industry has conditioned you to chase an absolute myth. The consumer-facing world is built entirely around marketing the narrative that a high credit score is the ultimate summit of financial health. You are taught that if you pay your bills on time and keep your balances low, the gates of institutional capital will swing open automatically. This narrative is a commercial illusion manufactured to keep retail consumers trapped on a treadmill of superficial score optimization. The brutal reality of modern banking is that institutions do not fund credit scores, they fund risk profiles. While you are staring at a static three-digit score on a colorful dashboard, the bank's internal systems are running deep learning algorithms that parse your behavioral metadata, evaluate your relationship depth, and cross-reference your lifestyle footprint against massive statistical default arrays. The three-digit number you track so diligently is nothing more than an entry-level gatekeeper designed to filter out baseline subprime liability. Once your profile clears that initial retail floor, your consumer score is effectively discarded, and the core algorithmic engine takes complete control of your application. If you are structuring your financial profile based on what you see on a public consumer portal, you are actively configuring your data inputs for an underwriting matrix that was permanently dismantled over a decade ago. You are playing a high-stakes game using a manual rulebook, while the house is running a hyper-automated, predictive artificial intelligence grid. The history of this great financial deception runs deep into the architecture of modern credit marketing. The public credit score was never designed to be an absolute roadmap for wealth or elite capital acquisition. It was created as a standardized scaling tool to help institutions mass-market high-interest retail debt to the general population. It was converted into a consumer product, packaged into sleek applications with bright user interfaces, and marketed as a badge of personal character. You were taught to chase a 750 or an 800 score because the system required a compliant, predictable consumer base that could be easily cataloged and sold financial products. This focus on the public score created a massive blind spot. Generations of entrepreneurs and investors grew up believing that the dashboard number was the single source of truth, completely unaware that behind the public facade, the top Tier 1 banks were quietly building an entirely separate, private internal data infrastructure. While the public was hyper-focusing on moving their score up by 5 points, the banks were designing complex machine learning algorithms capable of looking past the score entirely, rendering the very metric consumers chase completely secondary during a real funding event. To fully comprehend the depth of this structural misalignment, you must contrast what you see on your personal monitor with what the institutional risk engine extracts during a hard pull sequence. When you look at your credit profile through a retail application, you see a clean, simplified, heavily curated dashboard. You see your overall utilization percentage, a summary of your open accounts, and a list of hard inquiries. It looks like a balanced, stable ledger. But when that same file enters the bank's underwriting gateway, the machine strips away the colorful formatting and translates your entire life into a dense, multi-dimensional data matrix. The bank does not see a static percentage of utilization. It sees a real-time graph of your liquidity velocity. It tracks how long capital rests in your accounts before being deployed. It maps the geographic coordinates of your transactions to see if your spending patterns match the economic volatility of your zip code. It evaluates the financial stability of the companies you do business with. While you are looking at a simple confirmation that an account is current, the bank is looking at an advanced risk ledger that tracks your dependency on revolving lines down to the absolute second. You are looking at a static grade. The bank is looking at a fluid, predictive model. To understand why your perfect file was instantly rejected, you must realize that a dramatic institutional shift occurred across the banking landscape. The traditional loan officer who sat behind a mahogany desk, analyzed your local community status, evaluated your character, and manually signed off on your capital limits is completely gone. Modern Tier 1 lenders like Chase, Bank of America, and American Express have fully migrated their entire underwriting infrastructure to automated neural networks. These are deep learning machine learning models designed to achieve a single clinical objective, calculating your explicit probability of default. The algorithm does not look at your credit file as a historical trophy or a certificate of good behavior. It treats your profile as a living, real-time data stream that changes its mathematical orientation with every single transaction swept across the payment networks. When you hit Submit, the core algorithm doesn't just pull a standard credit report. It executes an instantaneous, multi-layered audit across private banking databases, regional census registries, and merchant metadata clearings. It strips down your entire transaction history into raw numerical inputs to see if your structural data matches the exact behavioral patterns of borrowers who previously defaulted on their obligations. If the machine detects a single micropattern that correlates with financial distress, it triggers an automated restriction protocol. The system doesn't deny you because you have late payments. It denies you because your data trail matches a high-risk cohort. The most guarded secret in the modern lending ecosystem is the existence of the private internal bank scorecard. Every major Tier 1 financial institution operates a completely proprietary internal scoring model that runs completely independent of public FICO or Vantage systems. When you open a basic checking account, establish a business entity relationship, or run an operational line through a specific bank, that institution begins compiling an internal risk rating specifically for you. This internal score is heavily weighted by your deposit density, your relationship depth, the consistency of your cash flow streams, and your historical transaction velocity within their specific ecosystem. An applicant can walk into a lender with a modest 720 public FICO score and receive a massive, uncollateralized six-figure approval simply because their internal bank rating is maximized through deep liquidity placement and clean account age. Conversely, an outside applicant with a flawless 800 FICO and zero relationship history with that specific institution will routinely face immediate automated denials because their internal bank scorecard is sitting at absolute zero. The machine interprets the lack of proprietary data as an unmapped risk variable, automatically defaulting to a denial posture to protect its capital allocations. Behind the public score sits an array of non-score risk variables that modern automated underwriting engines evaluate with clinical precision. The first major variable is data velocity. Uneducated retail consumers assume that if they space their credit applications out over several weeks or months, they are demonstrating calm, calculated financial management. In the eyes of an automated machine learning model, this behavior triggers an immediate systemic red flag. Data velocity measures the exact speed, density, and chronological frequency of your interactions with financial networks down to the absolute millisecond. When you submit an application to one issuer and then submit another to a separate issuer, 3 weeks later, you are not showing patience. You are creating a high-velocity data footprint during a latency gap. The core algorithm tracks how rapidly your profile is querying the financial system for liquidity. If the machine detects a pattern of sporadic, fragmented inquiries across different bureau clearinghouses, its predictive modeling instantly interprets that data velocity as an active search for emergency capital to patch an internal operational cash flow deficit. The system calculates that your velocity is spiking, which automatically drives your internal risk rating into a higher hazard tier. To the automated engine, a sudden sequence of uncoordinated data queries indicates that the borrower is experiencing unreported financial pressure, forcing an immediate automated denial to prevent institutional exposure before the next data sweep occurs. The second hidden pillar driving these instant rejections is multi-bureau cohort mapping. The modern underwriting matrix never evaluates your credit application in absolute isolation. The moment your data packets stream into the bank's mainframe, the core algorithm programmatically pairs your individual file with a specific cohort, a statistical control group consisting of tens of thousands of individuals across the country who share near-identical age brackets, geographic coordinates, professional classifications, and historical borrowing patterns. The system then runs a continuous, predictive live simulation on that specific cohort's historical performance. If the bank's deep learning models show that 80% of the individuals within your mapped cohort experienced a severe default or an account delinquency within 24 months of crossing a specific utilization threshold or changing their spend velocity, the machine will preemptively slash your credit limits or issue a flat automated denial on your new application. You can have a pristine, spotless 800 FICO score with absolutely zero personal mistakes on your record, but if the strangers who share your statistical data cohort are currently showing signs of widespread financial distress under current macroeconomic conditions, the algorithm treats your profile as a high-probability threat. You are being judged, restricted, and denied based entirely on the mathematical behavior of your data peers, leaving you completely blind to the real cause of your rejection. This automated gap between excellent consumer credit profiles and actual funding approvals often traces back to structural timing issues and shifts in institutional capital appetite. Banks are not static regulatory bodies. They are businesses that purchase, package, and resell debt profiles for profit. At any given millisecond, a bank's internal risk tolerances are shifting based on real-time liquidity requirements and secondary market conditions. If an automated system has reached its maximum exposure cap for a specific class of business funding or consumer debt for that quarter, the algorithm will automatically tighten its internal approval thresholds. When your application drops into the system during one of these unannounced contraction cycles, the machine searches your data file for the slightest deviation from absolute perfection to trigger an automated denial. A file that would have secured a $50,000 approval on a Tuesday morning can be instantly rejected on a Thursday afternoon simply because the bank's macro risk matrix completed a real-time policy adjustment. Your denial isn't a reflection of your true financial capability. It is a mechanical mismatch between your profile's data layout and the current, real-time capital appetite of the institutional decision engine. To maintain your psychological stability and scale your operations successfully, you must master the art of the contrast loop, reframing every single automated denial not as a devastating personal failure, but as a simple, tactical product mismatch. When the automated system issues a rejection notice, it is not declaring that your business model is invalid or that you are untrustworthy. It is simply stating that the specific data configuration you fed did not match. The configuration you fed into its neural network did not match the rigid parameters required to clear its current risk profile simulation. The system is a machine. It possesses no emotional intent and no capacity for malice. It is an automated gatekeeper scanning a digital ledger. If you treat the rejection as a personal insult, you will stall your operations and fall back into the trap of superficial consumer score grooming. But if you treat the denial as a cold, technical diagnostic report, you can calmly reverse engineer the automated data trail, identify the specific non-score variable that triggered the algorithmic alert, adjust your data inputs, and route your profile to an alternative institutional gateway whose current capital appetite matches your exact configuration. To break free from this hidden predictive matrix and consistently unlock deep institutional capital, you must completely abandon the obsolete mindset of retail consumer optimization. Stop treating your credit profile as a static grade that you earn through basic good behavior and start treating it as a highly sophisticated, high-precision data asset that must be intentionally configured to pass the strict mathematical thresholds of automated neural networks. If you continue to navigate the 2026 financial landscape using the wrong map, you will continue to collide with immediate automated rejections despite your perfect scores. Nothing in the system is broken. You were simply shown a superficial retail model that has nothing to do with risk algorithms. You were shown a retail model that has nothing to do with how institutional risk algorithms actually judge capital exposure. The moment you shift your perspective, look past the public consumer dashboard and begin structuring your data inputs to feed the predictive machine exactly what its risk modeling requires. The gates of institutional leverage will open automatically. The era of guessing is officially over, and the era of structural data alignment has begun. The new map requires a deep understanding of behavioral consistency, transaction routing optimization, and automated relationship depth. This complete reality reset demands that you look directly at the final pillar of modern automated lending systems, behavioral spend trajectories. Lenders have completely moved past the primitive method of looking at just how much money you currently owe on your revolving lines. Their automated risk engines are now actively parsing exactly where you spend your capital by executing real-time audits on your transaction metadata. Every single transaction you process on a credit line is accompanied by a specific 4-digit merchant category code. The core algorithm systematically categorizes this merchant metadata to construct a complex behavioral timeline of your lifestyle choices, capital routing, and financial stability. Running high transactional volume through Tier 1 corporate luxury hubs, premier wholesale suppliers, major airlines, or premium logistics networks signals deep operational cash flow, stability, and high net worth liquidity to the machine's scoring scorecard. Conversely, if your transaction trail shows repetitive merchant category codes linked to subprime point-of-sale financing terminals, online balance transfer networks, secondary tier retail lenders, or emergency cash advance portals, the neural network flags those inputs instantly. The algorithm doesn't care if you pay the balance off in full 20 days later. The mere presence of those specific distress-correlated merchant codes signals to the machine that you are deploying secondary leverage to maintain your lifestyle or operational costs, causing the risk engine to automatically downgrade your internal bank score. Nothing is structurally broken within your financial world. You have simply been navigating an advanced digital space using a primitive, outdated map. The public education system and the retail finance industry spent decades training you to focus entirely on a superficial consumer number because that number kept you perfectly categorized as a predictable, low-risk consumer of standard financial products. They never intended to show you the internal levers of the risk modeling engines because those engines are reserved for the institutional architects who understand how to deploy capital at scale. The automated denial you experienced was not a dead end. It was a loud, clear invitation to shed your retail consumer biases and step into the reality of institutional risk alignment. The moment you realize that credit is not a grade you earn, but an institutional asset that you mathematically configure, your relationship with capital changes. Your relationship with capital changes forever. You stop guessing, you stop pleading with automated interfaces, and you start systematically positioning your profile inputs to command the neural networks. The system is operating exactly as it was designed to run. Your only objective now is to align your data footprint with the modern matrix of institutional leverage. In the upcoming short series for this project, indexed from 2A through 2F, we will systematically dissect the specific technical triggers to exploit these 3 pillars in real time. The reality check is complete.